In this video, I am going to share with you the best ways to park your cash in Singapore for higher yields. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics such as stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've also covered over 500 videos and over 200,000 watch hours as of August 2024. I occasionally focus on topics related to regional or world economy too. Interest rates have been falling in recent months. This has sparked a lot of discussion about where we can park our cash to earn higher yields. Today, I'll break down the latest interest rates on fixed deposits, T-bills, Singapore savings bonds, SSBs, and money market funds. I'll also share the pros and cons of each option and my strategy for maximizing returns on cash. Let's start with fixed deposits. The best 3-month fixed deposit rate in Singapore is 3.35% per year, offered by Bank of China. For 6-month deposits, Maybank offers 3.20% per year. DBS leads the pack for 12-month deposits at 3.20% per year. These rates are pretty attractive, especially for short-term savings. Now let's talk about Singapore T-bills. The yield on the 6-month T-bill has dropped to 3.113% in the latest auction. This is lower than the best 6-month fixed deposit rate. It's like comparing apples and oranges, but the fixed deposit seems to have an edge right now. Moving on to Singapore savings bonds. The October 2024 issuance offers a 1-year interest rate of 2.59% and a 10-year average return of 2.77%. This is quite a drop from previous months. The 1-year rate is well below the best 12-month fixed deposit rate. But remember, SSBs let you lock in yields for up to 10 years, which could be a big plus if you're thinking long-term. Now, let's explore some other options to boost your yields. Cash management accounts are gaining popularity. These accounts aim to offer higher returns than savings accounts and more flexibility than fixed deposits. They invest your money in money market funds or bond funds. For example, the Fullerton SGD Cash Fund had a 7-day yield of 3.53% as of September 6, 2024. But keep in mind, these funds aren't guaranteed by the government or insured by SDIC. Some brokers are running promotions for their cash management accounts. Tiger Brokers and Moomoo Singapore are offering 6.8% per year on their respective platforms. That's like getting an extra scoop of ice cream on a hot day. Pretty sweet. There are also cash management accounts with guaranteed returns. Saif Cash Plus Guaranteed offers 3.4% per year for a 3-month term. Stashaway Simple Guaranteed provides a similar 3-month rate at 3.45%. These options can be good if you want a bit more certainty with your returns. For those with US dollars, there are some interesting options too. US dollar fixed deposits in Singapore offer rates up to 5% per year. US Treasuries are yielding about 4.11% for a 1-year term. And some USD money market funds are running promotions with rates as high as 6.8% per year. But remember, if you're converting from Singapore dollars, you'll need to factor in currency risk. So how do you choose between all these options? Here are 4 questions to ask yourself. First, are you okay with products not insured by SDIs or backed by the Singapore government? If yes, cash management accounts might be worth considering. Second, do you need quick access to your money? If so, look at options with good liquidity, like some cash management accounts. Third, do you want to lock in rates for a longer period? Singapore savings bonds might be your best bet here. Lastly, do you have any use for US dollars? If not, stick to Singapore dollar options to avoid currency risk. Here's what I would do. With T-bill yields falling, I'd spread my cash across T-bills and fixed deposits for money I don't need right away. I'd also look at SSBs and money market funds for a mix of liquidity and long-term yield. For US dollar investments, I'd only use money I'm planning to invest in US stocks anyway. Remember, this strategy assumes you've already set aside emergency cash in a high-interest savings account. It's like having a life jacket before you start swimming. Safety first. If you're comfortable with a bit more risk, you might want to look at high-quality Singapore rates. They can offer higher dividend yields compared to T-bills. But that's a topic for another video. If you guys enjoyed this video, then you're going to love my video on SG Dividend Alert 5 stocks to watch now. In that video, I break down the top REITs that can provide you with a steady stream of passive income. It's perfect for those looking to diversify their investment portfolio beyond just cash instruments. Check it out to learn how to potentially boost your returns while managing risk.